diving in to understand what the real challenges organizations are facing in their supply chains, and looking a little bit to see how insurance can be a mechanism to help to de-risk some of those challenges. So my name's Lisa Kodo. I am the ESG specialist here at Lockton, and I'm going to be moderating this panel of special experts today. Just a quick word on housekeeping. We do have a Q&A channel. Would love to get as many of your questions as possible throughout. We are not going to be doing a live Q&A, sort of answering those questions live, just in the interest of time, really. So we've got a lot of content to cover, but we promise we will be catching up with each and every one of your questions afterwards, sending a recording of today's webinar to you as well. So please ask your questions in there. So I'd like to start by introducing my panel of expert risk and insurance colleagues. So starting here with Luke Withers. Luke is a partner at Lockton. He leads our major accounts, client leadership and growth teams, and he's shaping our industry vertical strategy for the UK. Luke looks after Lockton's largest UK clients, and with 15 years has a lot of knowledge around their large and somewhat complex organisation structures. Passing on to Reem Al-Khatib. Reem is a risk management executive here at Lockton. She works with organisations across multiple different industries and geographies. She helps them to really strengthen their approach to risk management, to build long-term resilience and support strategic operational growth, and has 7 years experience working across enterprise risk management, business continuity management, supply chain risk management, and emerging risks. In her spare time, Reem also serves as honorary visiting fellow at Bayes Business School, helping to support the development of future risk professionals. On to Tristan Fletcher. Tristan is the co-founder and CEO of Chai. And Chai helps supply chain and procurement teams to turn raw material volatility into foresight using AI to forecast commodity prices, strengthening sourcing decisions and improving resilience. His background spans manufacturing, supply chain consulting, computer science, AI, and has worked with institutions such as Cambridge, Imperial and UCL, as well as commercial roles with many global investment banks and hedge funds. And finally, to Chris Strong. Chris is the global head of HDI Global's ESG Risk Solutions team. They are tasked with developing innovative ESG insurance products across HDI Global. And the majority of Chris's career has been in environmental underwriting for several of the major global insurers, managing a diverse range of portfolios across different sectors. So welcome, panelists. So I'm going to start with just a little bit of sort of scene setting. As we can see, organizations working towards resilient, sustainable supply chains are facing a reality of a very troubled risk landscape where we see increased amount of complexity, much more interconnectedness of suppliers, and definitely an increase in the unpredictable outlook as well. Today's supply chains stretch across hundreds, thousands, if not tens of thousands of suppliers across multiple jurisdictions, lots of different regulatory regimes, and often visibility is limited to not far beyond sort of tier one suppliers. So with complexity comes risk. And just to give a little bit of perspective around some of those risks, and again, we don't have time to uncover all the different risks that supply chains face today. We may well do follow-up webinars to sort of unpack and learn about different elements of them. But there's a few risks today that we would like to sort of dive into and cover in a little bit more detail. One of those is around human rights risks. And so human rights risks are often found deeply embedded in global supply chains. Worker abuse is severely underreported. However, the ILO's latest statistics estimate that more than 27 million people are caught up in forced labour, and almost 138 million children are involved in child labour. So big numbers. However, the World Benchmark Alliance estimate that only 1 in 10 companies actually assess human rights risks in their supply chain. So there's definitely a large gap between ambition and implementation. of those. Then there's also regulatory change. So companies are facing an increased mix of supply chain due diligence, reporting requirements, a lot of anti-greenwashing requirements as well. This is coming from the EU's due diligence sustainable reporting requirements. The UK as well is coming in with its sustainable regulation, disclosure reporting. And so this is really moving supply chain risks to not just being operational concerns, but really it's increasing legal, reputational and disclosure risks as well. So it's moving it to a different category altogether. Wouldn't be Climate Week without talking about climate change disruption as well. Geopolitical instability also puts a lot of pressure on supply chain continuity and access to materials. Reading a lot of what the IEA have been doing on critical minerals and critical materials, despite there now being an increased supply of critical materials, the IEA does still warn about a lot of price volatility risk due to a high amount of concentration in the supply of these critical raw materials, which will definitely lead to vulnerability and disruption. And it's not just critical minerals, also sustainable materials, sustainable but not necessarily stable. So we can often see that circular inputs are increasingly exposed more so than sort of their virgin material equivalents, with analysts warning of multi-million ton shortfalls in recycled plastics as an example by 2030. So there's a lot in that. So to bring all of this together, so we're mentioning human rights, regulatory pressure, climate disruption, geopolitical uncertainty, and material volatility, it's clear that sustainability and resilience aren't separate agenda items. In fact, they're very much part of the same risk management challenge. And that's really why today's discussion is so important. If these risks aren't properly understood and managed, they can slow or if not stall progress towards building out really strong, resilient supply chains for organizations. But if we find ways to de-risk, there is a chance of unlocking increased investment, helping to accelerate change and helping to build not just responsible, but also very commercial viable supply chains for organizations going into this unpredictable future. So this is where we think insurance is able to take on a transformative role. It's often seen as a safety net, which it certainly is, but it can also be an enabler of innovation, of confidence and scale. So that's really where we want to concentrate and talk about today. So moving to you, Luke, to start with. So you work with clients across sectors and at very different levels of supply chain complexity. How have you seen supply chain and sustainability related risks evolve over the past few years? And what issues do you see keeping your clients up at night?
Yeah, I mean, I suppose you've certainly touched on several of them, you know, with that introduction. But I think the big reality that people are dealing with now is this kind of great fragmentation, as it's called. You know, the kind of geopolitical landscape we're in. You know, we've had really kind of almost half a century, if not more, of relative stability and a general understanding of kind of free, frictionless trade. You know, that's kind of unraveled quite quickly for people in the last 12, 18 months. You know, aspects of that are being weaponized and leveraged. You know, we've seen it with the Strait of Hormuz, and we've seen it with trade sanctions, etc., over the last 12 months. So I think we're kind of at a key inflection point now with all of these risks kind of converging and happening concurrently, you know, very much interdependent on each other and kind of exacerbating each other as well. And that's creating some kind of quite big systemic risks for clients, for the insurance market. You know, we'll come on to it afterwards around kind of some of the limitations and where the insurance market has a role and where it doesn't. But conventionally, you know, dealing with big systemic interconnected risks, you know, that is a challenge for insurance to be able to respond to, just because of the very nature of how sizable those losses can be and the available capital that's in the market. So, you know, I think when we talk to clients a lot at the moment, it's that kind of these risks unfolding, the regularity and severity of those events when they happen, the unpredictability of it, and I think it's that ability for businesses to be able to respond to those things quickly when they have had and built supply chains, as I say, over the last 50, 60 years that have relied upon a relative degree of certainty that's almost vanished in quite a short space of time. We saw a bit of a trend off the back of the pandemic of people starting to onshore and nearshore supply chains. We're seeing that unfold the other way now, a bit of a reversal of that, certainly in the UK with trade policy and government policy, wage inflation, energy inflation. People just can't make it economically work at the moment. So I think the CPI put a statistic out a few weeks ago saying that 25% of businesses in the UK now are considering completely offshoring production. That's a growing trend, and when you take into account all of the risks we've spoken about, that's exacerbating the problem even more. You spoke about climate change. Again, severity, regularity wise, we're seeing more of these big weather related events unfold, even in Europe. Major floods. I had a client of mine last year that had quite a severe flood loss at one of their key aluminium suppliers. Their just-in-time manufacturing operation, heavily reliant on aluminium. The impact on that on them as a business in terms of production certainty was significant. And these are suppliers that conventionally you wouldn't be mapping and saying we've got a big flood issue. So again, that ability to really understand your supply chain, not just at the tier one level. It's quite interesting that the big tier one suppliers tend to be relatively resilient businesses themselves. They're big global operators. Where the pinch points actually unfolding is that tier 2, 3 or 4 supplier that you weren't even really aware of, or it wasn't kind of featuring on your risk register, but actually critical single source supplier, single location, and all of a sudden it's now in an area or a geography where it is going to start to see more volatility. And we'll come on to it afterwards, but that getting that data, getting that information, being able to get that granular within your supply chain it is difficult for businesses. So I think those are some of the big issues that we're seeing, and that transpires then into the losses that we've seen in the market, the disruptions that we've seen, and businesses are having to deal with port closures, they're having to deal with supplier insolvencies as a result of some of those compounding issues, commodity price volatility, and the impact that has on the bottom line and margin. All of these things happen concurrently, and that's that interconnectivity bit I mentioned before. So yeah, it is tricky. There's those key pinch points and choke points in supply chains now that are really coming home to and coming into perspective, whether it be, I mentioned Hummers before, but the Suez Canal, and we saw the Ever Given blockage there probably a couple of years ago now. The Baltimore Bridge strike. These things happen and it becomes so systemic because everyone is so reliant on that kind of frictionless access and trade into these key ports and key trade routes. So yeah, those tend to be the big issues that clients are dealing with, and they want from us certainty around what's covered, what isn't covered, where can we access capital, how do we manage these risks.
And you primarily look after large clients, and obviously a lot of what you've just spoken about is big global concerns. Do you see the same concerns on smaller businesses as well?
Yeah, absolutely. I mean, a lot. Most businesses now, certainly manufacturing businesses in the UK, whether they have a large global footprint or not, they are reliant on global supply chains. As I said, that tier 1, 2, 3, 4 aspect of it. The world has set itself up, the global economy has set itself up in a way that it is interconnected. It does rely on kind of complex global supply chains. So even if you don't directly have a big global footprint yourself, you are somewhat impacted by it, whether that be in a primary or a secondary basis. Commodity price volatility is a prime example of that. You are still large buyers of resources and commodities, so they might see the aftermath of some of these events. They're not necessarily directly having to deal with them, but I do think particular industries, manufacturing being the main one, you can't escape some of these realities.
Okay. And so you mentioned insurance and the role of insurance. Do you think organisations fully understand the role of insurance and how insurance can help them manage those risks, or do you think that there is a gap between what clients need and what that they think insurance is able to offer them?
there's definitely a gap, and I see that lack of understanding at all layers of the market. Big complex buyers with in-house insurance teams, and smaller buyers that don't have the luxury of that. Everyone equally still has a bit of a lack of understanding, and the market itself does around what solutions do we have, are they at scale, and there is definitely a growing coverage gap when you look at some of the exposures we spoke about before: port closures, sanctions issues, war, etc. These are common exclusions under policies. Your contingent business interruption coverage that you can buy. So most conventional policies are really predicated on physical damage at your locations. There is, as I say, contingent business interruption cover you can buy, which can extend to kind of key suppliers and customers, but that has limitations. The limit that you can buy is often quite restrictive. It might only extend to tier 1 suppliers or named suppliers. You've got to have a lot of information and quality data to be able to go and insure some of those big risks. So, the market, unfortunately, I referenced this before, is not well equipped to deal with really big systemic risks. There is that limitation on capital and capacity that's available there, and the market is there to spread risk. That's its very nature. So it will look to condense and consolidate and limit its exposure to some of these big events. So I think clients need to know that clarity around what can be insured, what can't be, where those limitations are. I think using insurance as a vehicle where you have really well defined acute exposures, I think it has a real role to play there. But it shouldn't be seen as a panacea for these sort of exposures. I think we often talk to clients about this, that use insurance as a tool in your arsenal in a very strategic way, but it can't replace your kind of larger strategy around resilience and the operational management of risk in your supply chain. There are, and we'll come on to it in a little bit with the guys from Chai as a really good example of it, but there is innovation coming to market. Parametrics has a big role to play. It's the thing that people talk about the most, and but again, that has limitations. It's largely weather related. You need an index to sit behind it. Again, you need to be able to define and quantify the risk and know exactly where the exposure point is. There isn't abundant capacity there yet. I think any innovation that tends to come to the insurance market, certainly at the start, before you get huge adoption and scale, it is limited in scope and capital. We saw that with even the cyber market 20, 30 years ago. As it came in, limits were relatively small, the market grew. We had a bit of an inflection point with that market a few years ago, but again, now capital's starting to flow, the demand is there, and that market is growing all the time. We're kind of at that point with a lot of these bits of innovation, whether it be parametric or specific products that are being set up to deal with these supply chain issues. They are there, but clients need to be aware that they can be limited in scope and scale. So that's my point around using it in a targeted way, where you've got a definable exposure. It's maybe relatively limited. I think insurance has a really clever role to play in some of those things, and the more clients adopt that and use it, the more the demand for those products grow, the more the market and capital base behind it will grow concurrently. So yeah, definitely a coverage gap, definitely a lack of knowledge for buyers around what is covered and what isn't covered. But certainly there is innovation coming, and you mentioned before about the role that insurance can play. It is in driving that innovation and driving the adoption of that, educating buyers, and trying to get capital attracted to the market to solve some of these bigger issues.
Thank you. So that leads nicely on to Reem. So I guess where risk transfer stops and there isn't capacity to do and fulfill all the different challenges, strategic risk and resilience perspective that Reem you look after. So how, from your perspective, away from risk transfer, do you see how organizations can be thinking about their supply chain risk today? Do you think it still sits as a procurement issue, or do you think it's should be viewed at a more strategic sort of leadership team level in order to manage it there?
Obviously, I'm going to suffocate as soon as you come. But we talk about resilience a lot in the session, and I guess it's quite good for us to just take a step back and redefine it. With resilience, we talk about an organization or an entity or even a country's ability to absorb shocks and then to continue to operate over time. Focusing on one area is not enough to develop or enhance that entity level resilience. So for us to lump that supply chain issues within procurement would be quite overwhelming as well. If we think about it at a larger scale, and we think about the different components of resilience, you're looking at it at that enterprise strategic point of view, but by nature. From a procurement level, it is important, but supply chain management is very different to supply chain risk management. You might have identified your suppliers, you have built those relationships, you are fulfilling that purpose, but how are you then overlaying that additional let's say risk layer on top of the information you have already on your suppliers? Luke mentioned already the pain points we have around everything that falls beyond that tier one. We might have enough information on our tier one. They are quite robust, but anything that falls beyond that are our pain points, let's say. So trying to fit it under one bucket is quite hard. Yes, supply chain management is quite important. It does need to sit on that strategic enterprise point of view, but then supply chain risk management is important. And this is where we start pulling the different expertise within an organization to layer their point of view and subject matter experts into understanding, okay, how does that impact the organization? When we think about supply chain risk management, a lot of it is linked to the disciplines around business continuity management as well. You need to understand your own entity's criticality. What are our products, our services, what are critical and what can we not survive with if we can't provide that service or that product, and then we link it back to our suppliers, and then we build those different levels of tier one, tier two, tier three, etc. There are issues around concentration risks that fall beyond that tier one level, and I guess this is where the issues stand, because you have those single points of failure that sit in that supplier network, let's say, and sometimes it's quite hard to find the substitute because of the specialty of what they provide and produce, and geographically where they're positioned, and is it actually financially viable for us to even think about a second supplier or going down that line. So there are multiple things we need to think about when we think about supply chain risk management, whether it's our financial point of view, our customer priorities and product portfolio, and what's critical for us, and then what suppliers would feed into that value chain in general. We also look at things in silo, unfortunately. Yes, we have our own supply chain, but there are other entities that are dependent on us as part of their supply chain. So the impact is not localized to us as an entity. It will ripple, and just like anything that impacts us will ripple across our, let's say, value chain, etc. There are those quite distant impacts that will come back to us that we need to consider, and then make sure that our strategies are robust and resilient enough to absorb any of those unpredicted unknowns, let's say. So it is quite complex. It is quite hard to try and quantify what that risk looks like. And that's why we talk about resilience and a point of let's focus on our internal circumstances and capabilities, make sure we're strengthening ourselves at those different layers from a financial, strategic, operational, people point of view, and building that flexibility across those different layers so that no matter what that event or impact might look like, we have some level of agility to react to whatever might happen to us. And part of that is having that level of understanding of what could happen to your supply chain and those suppliers across those different tiers. Yeah.
Okay.
Hopefully that answers the question.
It does. And I was just wondering, you covered everything there, but what do you think the client's blind spots generally are? So when you're asked to come in and help, and you work with them on risk frameworks and business continuity and on resilience planning, which you've just articulated well, but what are their blind spots? What are they finding hard, particularly beyond their tier one? And so what does good support look like in helping them to build that visibility?
We have a lack of data, unfortunately, and there is a lot of confidence in the assurance we get from tier one suppliers, because we'd assume that they've done their due diligence as well in their networks. I guess it's going beyond that, where now we are working as a network that is dependent on each other and trying to get that data further back and then feeding it into our understanding of what that supply chain looks like. But also having that data is not enough. We have clients that do get that data. They have data way beyond that tier one, but what do you do with it? What insights can you get from that that will inform your decision making from a supply chain point of view? So I would say, yeah, it's data is the blind spot. We can have as much data as we want, but what are you actually doing with the data to strengthen and reinforce those supply chains? It comes back to also having those partners around them that can translate that information in a way that, let's say, strengthens their understanding of their position of and what they require. And that falls onto some of the support we would provide other as their brokers or their insurers or risk managers that sit in between all of those.
It's almost like we scripted, but I think that brings us perfectly on to Chai and the role of data and AI and forward-looking insight on that one. So I briefly mentioned volatility in critical and sustainable materials. And obviously we've talked about the complexity of supply chains, but Tristan, how can data, AI and analytics be used better to help organizations move from reacting to disruption to anticipating it earlier and making better decisions?
So I think, yeah, this does feel like it's been perfectly teed up. So thank you, everyone came before me. That typically supply chains and the risk management of supply chains is very reactive. People have a hindsight bias and say it was obvious that the price of fertilizer would go up when the Straits of Hormuz are closed. It's obvious that the price of wheat's going to go up when Russia invades Ukraine. But actually at the time, there's so many things going on. There's so many of these weak little signals that are happening that we claim we knew that there was this relationship after the fact. But at the time, you actually don't know what's going to happen next. And AI is very, very good at looking at all these weak signals, all these little things going on in the world and saying, actually, well, I've seen something like this before, and this is the spectrum of outcomes that might happen next. And giving you some idea of how certain the scenarios that are being forecasted are going to transpire so that you can take appropriate action. And I think we've talked about there being a lot of data or not enough data, actually. I think people have different views on that. We have a separate view, which is sustainability has created an awful lot of transparency. It's excellent. That transparency is excellent. It's making the world a better place. We're pricing all these externalities and bringing them into, our pricing. But that creates a much bigger haystack that we're searching for the needle in, right? Where do we focus? Which data sets are really important? So we're finding time and time again that people are saying, well, I've got all of this data. Previously, I just knew the price of stuff. Then for a bit of time, I knew how much was sitting in a warehouse. And maybe more recently, I can buy some cheap satellite pictures of some stuff. And now you've got all these ESG reports and other bits of information. So the challenge is trying to make sense of a greater swathe of stuff constantly coming out more frequently in this highly interconnected world. And AI is very, very good at knowing where to shine that torch and saying, okay, this data set today matters. The price is probably going to do this. I've got this much certainty. Therefore, I will make this decision to act on it. Yeah.
Can you give me some sort of practical use cases around that as to where you're seeing this AI generated data? Let's take it. You're right. The problem of having big data.
Yeah.
And making sense of it. So, could any sort of case studies or practical uses?
I can give you many. So we, for example, are often looking at data sets that are giving inconsistent views on what's going to happen next. And I think this is what's difficult when you're a human being. Let's say you're a trader and or a person working in procurement, and there's a load of stocks building up in a warehouse of the thing you care about. Maybe it's wheat. And you've also seen that the weather's been really benign and the yield of all the places that the kind of wheat you care about is very high. You'd expect the price to come down. But then actually, it may be that the AI system has identified that there's an awful lot of speculators in the market through commitment of trades reports saying the price is going to go down. And historically, when it's seen that combination of signals before, it did very strongly mean that price is going to go down. So in procurement, you might actually, instead of buying your wheat just then, wait a little bit. Or instead of trying to hedge out that risk by buying a futures contract at the CME to protect you against price going up, you'd say, well, actually, I don't need to because I'm pretty sure the price is going to go down. Now, we've had examples like that in many of the raw materials we operate in, where the consensus was maybe that the price was going to go one direction, but actually the aggregate of all these little weak signals gave a different view, and people have acted on that, and in many cases saved large amounts of money through this forecasting.
So when it comes to emerging and sustainable materials, where do traditional hedging and risk tools tend to fall short?
So a lot of the commodity markets, like the futures markets, were set up ages ago, like 1850s, to represent the platonic ideal of a raw material. So if I can hedge out my risk, I need a lot of people who have exposure to something that's very similar to this thing. It's the template of this raw material. And that's great in markets like wheat or cocoa, even oil. But a lot of the more recent, particularly sustainable markets, are very localized and they're very new. And because of that, large financial institutions haven't stepped in to try and provide liquidity, to provide a mechanism for people to hedge out that risk. And that means corporates who probably want to do the right thing are not hugely incentivized to, operate with recycled materials because they have no way of removing the price risk. If something like AI comes along, conveniently, the Chai comes along, and we can price any risk because of this emerging technology that we've got, under our hands, we can then effectively come up with a price in anything, as long as we can see historically a little bit of the previous prices, and we know what to look at, which locations to monitor with satellites, what warehouses to look at in terms of stocks. We can then come in and say, right, this is the associated price risk. And the benefits of that are when, large organizations, for example, I'll give you a very concrete example. There's very well-known drinks companies are looking at making their bottle caps out of recycled PET versus normal PET, but they don't because they can't hedge out that risk. We can go to them and say, well, this is the price of that risk, and we can operate that, and then they can move to these nice new recycled markets. And that's very gratifying, obviously. At the same time as all this uncertainty and all this sort of understandably negative PR around AI, it does actually have some very tangible physical benefits in this world.
Great, thank you for that. That's a great area. I guess moving along more of the traditional insurance market, I guess, and understanding what the insurance is doing on that side. So Chris at HDI Global, as supply chain ESG risks come under more scrutiny, as we're seeing in a lot of the regulation that's being driven in. What's driving HDI's focus on ESG related liabilities, and how are you thinking about this risk from an underwriting perspective?
Yeah, so when you think about traditional insurance solutions, and especially on the ESG side of things, within the UK, it's always been the focus on the E, so pollution and biodiversity risks. HDI, we're looking to develop a global environmental team, but they did a survey of clients. They're a big industrial insurer, so they have huge industrial clients with big supply chains. And there's a raft of new legislation and regulations coming into play, like you mentioned earlier. That means that clients are facing new risks. So instead of just focusing on the pollution and biodiversity side of things, we are looking at the wider ESG side of things to ensure that clients have new solutions that don't exist at the moment. So the CSDDD and CSRD mean that, clients have a very real financial liability, third-party liabilities as well, arising from their supply chains falling foul of various social breaches. And one of the solutions that we're looking to put in place is a policy that covers those aspects.
And this is still pretty early days, I would imagine. So are you seeing client demand yet, or is it still a lot of education that you're working with organizations on?
So there's already existing legislation in Germany, the German Supply Chain Act, and we have a very similar product launched there a couple of years ago. So we're already seeing feedback from clients that this is something that will be purchased more widely when the CSDDD comes into play in a couple of years. So we think it's a very real risk that is going to be apparent in a couple of years, and we're trying to get ahead of the curve.
And to avoid the perception that insurance is protecting poor behaviour, can you explain a bit about how your solution works in practice? So what do you need to see from clients in terms of their own due diligence and governance and their supply chain oversight before you're prepared to cover them?
Yeah, so I guess I'll talk about the different coverages in a second, but I guess like any insurance product, it's designed to work alongside appropriate due diligence. It's not there to replace due diligence. So we are only going to be insuring companies that have the appropriate risk management and due diligence processes in place, and also they respond to these scenarios in a quick and appropriate manner as well. We're not going to be insuring businesses that don't have those systems in place. So I guess the coverage that we are looking to provide, essentially there's a raft of different breaches that our client's supply chain could face, whether it's child labour, discrimination, workplace health and safety issues, even environmental issues, and supply of fresh water and those types of things. And what we're looking to cover is the financial losses that our clients face as a result of their supply chain having a ESG breach, but also the financial losses of their customers as well. We'll cover the third-party liabilities from the victims of those potential impacts as well, legal defence costs, and probably most importantly, the reputational management costs and crisis management costs as well, that will help them deal with the issue as quickly as possible to limit those overall costs.
Okay. Thank you. So keen to open some questions up to all of you. I guess if insurance is going to become a real enabler of sustainable supply chains, what do you see needs to change the most? So we've mentioned data. We've touched a little bit on regulation that's coming in, whether that needs to be clearer and stronger and more consistent, ? Collaboration, risk management, we've talked about as well at length, and then the increase in sort of insurance solutions. So what do you think are the triggers? Is it a combination of all of them? Does one go first? Open to anybody to jump in.
I actually controversially think it's not one of those things, and it goes back to a point that was made earlier, the word education. I don't think people know in a lot of organizations, particularly the smaller ones, that these products exist. Mm-hmm. It's not even in their vocabulary. Being very direct about it, we look at, for example, what people are searching for on Google and try and optimize that. People don't search for ESG insurance. They don't search for raw material price insurance, whereas they probably would for many other more typical insurance products that you're all FA with. And so I actually think education is a very important point. It doesn't really matter if it's AI or not, or if it's, I don't know how these things are created. Just knowing they exist would make a huge difference, I believe.
Actually, such a good point. We talk about the evolution of the insurance market. Also, we might evolve, but then, as you said, like individuals are not aware that that evolution even occurred. We spoke about education, data, the different pockets of information that everyone holds that could paint that bigger picture. And we see if I translate it back to that organization, for example, from a risk management point of view, each, let's say, department would have different information that would feed into that bigger picture that then could be translated back to the insurance market. And then we would work together to either create something or then enhance an existing solution that we already have. So it's, as you said, yeah, it starts with education, then that internal collaboration, but then external collaboration to transmit that messaging for us to do something that could be valuable for the business. Sorry.
Yeah. No, I'd agree. I think the collaboration bit, I think it's a frustration that, there is a lot of information that sits in the insurance market, in particular on the physical risks of these businesses. If you go up to the reinsurance level in particular, those reinsurance capital providers are sitting across this entire ecosystem. All of these businesses will buy insurance for physical damage, property loss. A lot of these physical properties are being risk engineered, the surveys are happening. And that data sharing ability, obviously the sensitivities around GDPR and some of that stuff will be commercially sensitive, but the industry coming together to find a way to say, well, let's actually set up a portal here or give a risk rating to some of these businesses that could be shared collectively. There's a prize at the end of that for buyers and for the market to better manage that risk. But there's hurdles to get around that. The market has not been historically great at that level of collaboration and that sharing of that IP and that data. So I think definitely collaboration. And I think the other bit I touched on is capital. It's the ability to attract and deploy capital quickly, for these things to matter. And it links a little bit to the education bit, for these products to become more prominent and for them to become more accessible, it requires them to be scaled. And that requires capital to be sat behind it. It requires meaningful limits to be put out there. A lot of big buyers in particular look at this stuff and go, okay, well, it's interesting. I like the concept of it, but my exposure is 200 million, 100 million, buying 2 million or 5 million of cover. We'll take it on balance sheet, or we'll wait to see until that capital comes forward. And that's not just for some of these supply chain risks, it's everything. We talk about intellectual property, intangible assets. A lot of the risks on corporate risk registers for businesses now are deemed to be largely uninsurable or partly insurable. I think it's the industry's obligation to move quicker and attract capital quicker to solve some of these problems.
On the collaboration piece, I guess it's also important to understand each other's roles. So what are we bringing to the equation? With insurers, you have a lot of data and you have a specific specialty, let's say. As brokers, we have that first line conversation with the clients. We understand where they're coming from, but we also have that future look. We understand what might happen in that medium to long term, that then we can feed back into the market to start preparing for that change. Obviously, we work on the client side, but it's also in our benefit to get the market up to speed, because at the end of the day, we all are protecting each other against something that could be catastrophic. And we did say the market can't absorb everything, and this is where risk management comes into play. We balance each other out. Some of those pieces can be transferred to the market as a risk transfer strategy under that risk mitigation piece, but then we would work from that enterprise strategic point of view of lowering whatever we can lower down from a likelihood or impact perspective, and then anything else that could be absorbed by the market can be absorbed. But it's building it from the beginning and understanding, okay, as we're collaborating, this is our roles and this is how we need to feed into each other's capabilities day to day as well.
Okay. I was getting a sense from that along with the education, I think, is within organizations as to who's responsible and who's really looking at these risks. And I'm under the impression at times that it may be hidden in a risk register and it doesn't necessarily get up to the boardroom level to really put proper financial capital behind finding solutions for some of these problems. It almost sits in a too big to worry about problems. So I don't know what solutions we can come up with to try and I guess make these risks to be better understood and managed and brought up to a high level within organizations.
I'd say that's probably one of the biggest frustrations that we see within organizations, is that you might have several departments all talking about supply chain, going out to these suppliers, but with very different agendas. So you've got a team looking at the counterparty risk, you've got a team looking at the ESG or sustainability piece, or labour, or quality, and they're going out and asking the same questions sometimes of these suppliers in slightly different ways. They've got teams going out on the ground, but they're missing that overarching kind of risk and resiliency piece. A lot of that information is actually there, but it sits in little silos. And for me, that's where the kind of enterprise risk team or the insurance team, or whatever it might be in these companies, can be the glue that brings all of that together. Don't duplicate these things. If you've already got somebody going out there to do a quality audit or someone to go and do a sustainability audit, ask some questions around their resiliency, ask some questions around their physical risk mitigations, being a little bit smarter about how you use the resource that you've got, and bring that information data back. I think there's a prize there. Probably more of a challenge in bigger organizations where you've got these, fragmented departments. But for smaller organizations, we do tend to see that that's on one person. It's a procurement lead, and then they are just so far stretched that they've got to focus on the key priorities. The challenge at that end is that actually, they need support from others. Again, can they get information from external sources? What's the role, as Reem's articulated, for insurers and brokers in some of that knowledge sharing as well. But it's definitely something we see regularly and think that there's got to be a more simple way of managing that.
We talk about accountability and ownership in organizations, also integration of risk disciplines. So we'd see BCM sit separately to ARM, or we see it separately to supply chain risk management. What you said about taking it back to the board, when we say ownership, the ultimate ownership should sit with the board because it's a strategic issue that they need to have oversight of that. And we work a lot around risk culture. So how do we show the value of risk management? We need to speak their language. We need to re-articulate that messaging and change the narrative in a way that they understand as the board. And then depending on which other functions or departments are getting involved, you need to then speak their language and what they understand that impact is on them. And then the bigger picture is that enterprise corporate point of view. So when we talk about risk registers, you'd have that corporate risk register that sits across the organization, but then you have pockets of other stream works that are happening at a functional point of view, departmental point of view, project perspective, and that all feeds back to that corporate level that should be owned by the board or the executive leadership team, etc. So it's ownership, accountability, but creating that value where you are speaking that language and changing the narrative of it's not nuisance, it's not additional resources and money. At the end of the day, this is supposed to save us from losing that money that we want to invest in. That's the whole point of risk management, being using that as a tool or a driver for us to fulfill those strategic objectives, because you're reducing the likelihood of events happening that could jeopardize that ultimate objective that we're working towards.
In our experience, that's actually one of the challenges, is that we often use the metaphor of cyber. I think cyber, the impression I get is it's a lot more popular as an insurance product because there's been some very well-known breaches. And with raw material prices, I think people are either firefighting or there haven't been, in their experience, things that have happened to them recently that were an existential crisis. So the people at board level are going, well, I don't want to spend money on this premium. It's probably going to be all right, which I assume with a more established insurable insurance product isn't the thing. But when you've got something that's new, people are, well, I'm not sure. Why would I spend this? And unfortunately, I suspect it will only really get taken up when there's been a huge ESG breach or a huge, business going out of business because of a raw material price risk. That's human nature, but I think people are very adverse to spending money unless they're absolutely sure they're going to protect themselves from something that's going to put them out of business.
Actually, on that point, but because we do a lot of work on emerging risk research and just that horizon scanning and future events that could happen, I guess the only way to bring it back home is through exercises and scenario plannings where they see that impact on that organization. And sometimes you just need to put everyone in that room, say, okay, if that event was to happen, tell me exactly what could happen to your organization. And do you actually have the capabilities to withstand whatever could happen moving forward? Yes, the timelines of things materializing might be a bit longer, but given what's happening around the world, the velocity of risk is quite fast nowadays. It's materializing quite fast, and we're feeling the impact faster, whether it's direct or indirect. So it's that proactivity in risk management as well, whether it's internal or in collaboration with the markets, and then building those agile risk transfer strategies as well that evolves with that risk landscape.
And I guess it's moved away as well from it just being an operational risk we've talked about, but with disclosures, ESG disclosures on the up, and also litigation, particularly around greenwashing as well. I guess, just thinking, Tristan, to your sustainable materials and your bottle top caps.
Yeah.
Companies that market themselves with sustainable products and then find out the actual, recycled bottle top is actually too expensive and can't get hold of it.
Yeah.
Then ends up putting a regular non-recyclable cap on it, then risks having products that aren't as sustainable as is on the label. So risk of litigation coming in.
That's true. The second order effects of adopting a green thing, which at the time suits you, but ends up not suiting you. Very dangerous. Yeah.
Understood. So looking ahead 3 to 5 years, what would you say success looks like across all of you? Because you're coming at it from very different angles. So what role would you like? I mean, you've touched on it already a little bit, but what role would you like insurance and risk management to be playing in the sustainable transition ahead? Maybe start with you, Chris.
Yeah, I think we've kind of touched on it. I think the rapid change of pace of regulations and ESG exposures means that there's never going to be one insurance solution that fits all. So 5 years time, I would like to see ESG solution for supply chains, ESG solution for certain industries that will be different, and having the education in place already that people are well aware of these products and can price it into their insurance purchases year after year.
I would like to see the insurance industry do what it does best, and that's embolden businesses globally to make investments and do slightly riskier things. And I honestly think that a lot of businesses are not just like greenwashing. You know, the CEOs have children, they care about the future, they want to do the right thing, but the financial world hasn't created products that allow them to do that. So I would like people, you know, coming up with business plans and saying, well, I can get rid of this risk now thanks to the insurance industry, and, you know, do more recycling, use more recycled plastics, use more solar energy, anything that these nascent markets, because there is now somebody taking that bit of their risk away, and they can concentrate on what they do best, which is making bottle tops or electricity or whatever.
I guess I'll just build onto that. I guess every decision we're taking now is a risk-based decision. So taking that risk management approach, not seeing it as a negative, there are opportunities that we need to take advantage of, and you need to make your assessment around those opportunities as well to take advantage of them. I guess my point around also capital, you need to put the money to see the return on it as well. For you to have robust risk management solutions or strategies internally, there should be some form of capital associated to that as well, whether to make things more robust internally or to transfer to the markets where you can. So again, the efficiencies or cost cutting should not come at the cost of actually jeopardizing your own resilience because of the circumstances that we're operating in. I guess we have that very short-term vision of where we stand as organizations rather than our long-term operational continuity, growth, and resilience as well.
Yeah, I mean, as I say, really to add to those things, I think that the collaboration bit we touched on earlier, I think there is a real opportunity for the market to, you know, open itself up to knowledge share, to data sharing. You know, as I say, there's a huge source and wealth of that out there on these physical risks, you know, and the risk management controls across the entire manufacturing estate globally. I think the market's ability to bring that together in a way, I think, would be a real price, and pace of capital and innovation. I think that's, we've kind of touched on it, but the way to really move these things beyond being kind of fringe things that people consider, you know, to kind of meaningful risk transfer mechanisms is to innovate quickly and get capital behind this stuff. I think the market's got to wake up to the fact that, you know, I speak to a lot of heads of risk, chief risk officers, you know, and heads of insurance, and there is an increasing frustration with the fact that people look down their risk registers and go, what is the value of insurance here? You know, yes, it can cover our property and our liabilities and our fleet, etc. But there's this huge section here of exposure that's growing all the time that just isn't meaningful responses from the market to. And as I say, there is a reality that you can't just pivot to that quickly. We've got to attract the capital in, but there are examples of where that is happening. Parametrics and ILS bonds and catastrophe bonds. You know, we've seen a huge growth in that. The reinsurance market this year at 1/1, you know, first time in a long time, had a significant capital surplus. So it's possible and it's doable. I think we've just got to move quicker and at scale.
And how do we move quicker? What's the way of doing that? I guess there's no silver bullet, otherwise we would all be doing it.
Yeah, unfortunately not. And I think it comes back to the collaboration bit. You know, that no one single insurer or capital provider is going to solve this. I think it's about education again, education of politicians, education of the business and industry and the decision makers to bring people together to see the opportunity there. I mean, Tristan hit the nail on the head of insurance has a massive role to play in some of this, you know, enabling businesses to take risk and transform, you know, the industry, but it only happens if the market, if capital providers come together to try and solve these big problems.
We also need better understanding around these things. There's certain issues we can't be fast around because we need more information around it. We're looking at causes and effects, but there are triggers that we're trying to absorb as a market. How do we absorb it if we don't understand it? I guess it also looks back at our strategies. If we're thinking about our underwriting approach, what data are we depending on? Are we looking at just historical data? Are we looking at real-time information? How does that feed into our strategy as well? So I guess it's just thinking about that whole life cycle, insurance life cycle, including risk management as well. What can we do and what areas can we change that will give us that information faster for us to act faster as well?
Is there anything that anybody wanted to say that you've not had the opportunity to say about what your concerns are, or challenges, or where you see things moving?
I well, let's say some stuff about AI again, which is actually also creates a lot of risks. And you know, we talk about all of these interdependencies, and I think there's concerns that AI creates kind of herding behavior as well as helping mitigate it. And I think it's going to be very interesting, using the metaphor of, or the example of cyber, how the insurance industry starts to actually insure AI itself. Because like cyber, it was embedded as a risk in a lot of other things, and then it got carved out as a separate thing. I think we may have to start seeing that with AI. And possibly even when people are using AI in an ESG market or a raw material price market, that's, you know, somebody's insuring the model that's doing that as well. So I think there's a lot of interesting stuff around these emerging technologies and sustainability in general.
And actually, on that point, I think it's interesting to speak to clients a lot about this, that, you know, I think people need to stop seeing AI as a risk in itself.
Yeah.
You know, it's a massive amplifier of risks that already exist. Crime, fraud, cyber, you know, it's not a risk in itself. AI isn't this just thing that happens. It's massively amplifying, it's democratizing the ability for threat actors to do damage. I think that's how people need to start thinking about AI, not it's this big thing here that's going to just change everything, which it will, but we're seeing it happen incrementally. It's what's the real and present stuff now that it's making worse. And again, it's the market's ability to respond to that and say, right, actually, some of these risks now are transforming, they're getting bigger, it needs more capital, it needs more capacity, people want to buy bigger limits for certain exposures. And again, the education bit, you know, knowledge sharing, what claims, what activity we're seeing, how is that being passed back to buyers and consumers. So yeah, I think it's that would be my big thing with AI.
Yeah, great. So I think there's a lot of takeaways from today. And again, thank you for putting in your questions. Please keep them coming, and feedback as well on the session would be really useful to know what you took from it, what you might like to see more of as well. There's a lot that we talked about. I guess we can definitely say that supply chain sustainability isn't just ethical and environmental issues. It is definitely a risk and resilience challenge. No matter the cause, and we've gone through a lot of different causes and triggers, but organizations really need to understand their risks earlier, being able to price them and manage them and build them into decision making in more of a joined up way across the organization to make the smarter decisions. Insurance, risk advisory, and better data, they're all important, not just to respond when things go wrong, but to help organizations move forward with, I guess, increased confidence and sort of commercial viability as well. So that all comes from there. We will put a summary out of our discussions today and turn it into a white paper. If you're interested in that, we will follow up on email with those as well. I'd like to thank the panel today. For coming in, for everybody online for listening in and for your questions, and the team behind that you can't see that helped to organise and set this all up. This was our first London Climate Action Week event. Hopefully it's one of many. I think it's been a great week, the events I've listened into as well, and I know there's a lot of sessions, so appreciate you listening into this one because there was a lot of choice out there. So I believe we're going to end up with a QR code that you'll see that will take you through to a recent report that we've created around geopolitical risk. And so you can click on the QR code and have access to the report. So feel free to take that away with you as well. But other than that, we thank you for joining us today. Thank you. Thanks, everybody.
Thanks.